Hi there, Dave Keller here with StockCharts.com. Today on the final bar, my guest is Sam Stovall from CFRA Research in New York. We're going to talk about the seasonal trends in the markets. You may have heard sell in May and go away. Sam's going to share with us some data about how that actually plays out, not just in U.S. markets, but in non-U.S. markets. Overall, it was the tale of two markets today. The S&P first half, not too bad after lunch, came down pretty quick on news on tax implications. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a cloudy Redmond, Washington. Thanks for joining us every weekday after the close as we look at these markets together using the message of the markets themselves, using the disciplines of technical analysis, behavioral finance, trying to make sense of what's happening to investors and where their heads are at, what is motivating them to make buy or sell decisions, but most importantly, the message that price can provide us. There, you can restate earnings, you can restate a lot of things. You can't restate price, as one of my mentors, Ralph Ekampora, used to remind me regularly. I'm excited to talk to Sam Stovall. I've been thinking a lot about seasonal trends. You have this situation where the markets are, certainly overextended by a lot of measures in recent weeks and months even, and a lot of discussion over what that means for the remainder of the year. We've been in the seasonally stronger part of the year. Now we're entering very soon into the seasonally weaker part of the year, and that's a really interesting time to sort of review and reflect on potential downside and how to consider it. So excited to talk to Sam here in a bit. As a reminder, we have fantastic guests coming through the show a number of times every week. Next week, we have Todd Sohn from Strategas in New York. Coming up on Wednesday next week, we have Joe Duarte from Joe Duarte in the moneyoptions.com. Joe is a guest host on one of our other shows on Stock Charts TV called Your Daily Five. Does a really good job, and his background is in options, so tends to have an interesting a series of option scenarios, which we'll bring to light. I'm very excited the week after on May 4th, just to give you a preview. One of my mentors, Jeff Weiss, is going to be joining us on the show. The story may came up, but Jeff was actually with me. We were having breakfast when my daughter arrived about 13 and a half years ago, and I got the call from my wife. I was having breakfast with Jeff, and he may relive that moment on the air because he loves to bring it up at uncomfortable times. A lot of great guests coming up on the show. Let's move on to our market recap. So as I mentioned in the introduction, sort of two halves to today. The first half of the day was really sign of strength, and you saw the S&P close down a bit, or open down a little bit, but then started to move to new highs. And I was thinking, boy, this is just, small caps were actually leading, and I'm thinking, wow, this is just very much a risk-on sort of feel after, yesterday, which was also sort of a risk-on feel. But then Monday and Tuesday had a completely different dynamic. It was much more digestive, distributive, depending on what adjective you'd want to assign to it. Today sort of flipped very quickly. There's news about taxes and Biden plans. I don't want to go too much into the implications of that, but focus more on the message of the charts. The market certainly took whatever headlines were coming off pretty negatively, because you can see the steep decline that you saw after lunch, finding a bottom around 2 p.m. So the S&P closed almost 1% down, around 4135. Mid caps and small caps down a little least. So it was the largest part of the market that was feeling the weight. The NASDAQ 100 notably was down even more, down 1.25%. The VIX is almost back up to 19. This is after being around 16 not too long ago. 10-year yields actually ended up coming off. It was a pretty choppy day for bonds, which you can see the rotation around here ended up being a little low, around 155, and the US dollar up a little bit as well. On the commodity side, precious metals weaker, with gold and silver down pretty good. Copper as well, which is more of an industrial metal, down. The energy side of commodities up pretty good, even though the energy sector was actually down today. Cryptocurrencies continue to be mixed. If you think of all cryptocurrencies as a homogeneous group of things that go up and down, the last couple of days, you've seen certainly some dispersion, or at the very least differentiation. Right here, you have Bitcoin down about 2.5%, Ethereum up over 6%. So I would encourage you. I very oversimplified at times, especially as cryptocurrencies became more and more popular. I'm learning there's obviously a lot of different types of coins and structures and implications of those. So certainly pay attention to all the different pieces there. So looking at a chart of the S&P, again, midday, this looked like a very different environment. I'm preparing myself to talk about the S&P potentially regaining all-time highs, threatening the 4,200 level. I had all these sort of potential storylines in my head as I was reviewing the markets earlier in the morning for me. But then obviously we close a little bit lower. This is actually what's called, it's actually really, really close. You can't really call that a bearish engulfing pattern because the open's a little lower and the close is a little higher. So this is actually called a bearish Harami pattern, which is essentially a long up day and a long down day. And day two does not engulf the previous day. And, engulfing patterns are much more popular and much more frequent, to be honest with you. But this is also a short-term candle pattern with bearish implications. And if you forget about what the name is, but just think about the 2-day pattern here, and we can zoom in just a little bit here. Let's look at like a 3-month pattern and look at the candlestick. So if you know your candle patterns, right, the open is at the bottom of the candle, the close is up at the top. A solid bar, the open is the top of the candle and the close at the bottom. And quickly, if you forget what I just said, I always tell people, remember a solid candle, it's something solid like a rock sinking down in a pool. So you opened here at the top of the body, sunk down and closed down at the lower end of that rectangle. On a big open day, think of it something open, it's light, it's a balloon filled with air and it's floating upwards. So you open here at the bottom of this body and you close up at the top. And then the wick there, the shadow, if you will, the vertical line just tells you the high and the low trade. So here we had an up day yesterday, which was actually a wider range than what we saw the previous day. And then today you have a big long down close, but you can see the open is below yesterday's close. Today's close is above yesterday's open. So that's actually called a bearish Harami pattern. So what's interesting is you have that candle pattern coming off of the overbought conditions here for the S&P 500. So it certainly suggests weakness going into the weekend, maybe into early next week. And again, forget about the name, just think about the dynamics. A big up day showing a lot of accumulation during the day. Today was certainly more about distribution and profit taking, people being a little more risk off again by when all was said and done there at the close. Let's look at some sectors here very quickly. So we have real estate number one, healthcare number two, followed by industrial. So this is sort of a defensive-y, kind of a mixed top to the sector returns. At the bottom, you have materials, energy, technology. It's interesting with materials, there are a number of different things that are in play, but the first thing that comes to mind is FCX, which at times has been one of the top ranked stocks in our large cap universe. It's right now around 96 percentile. If you take the entire large cap universe, rank them in terms of technical attractiveness from 99.9 being the strongest and 0.01 being the weakest. So it's certainly in the top 5% of large cap stocks. What's interesting about the chart of FCX right now is all else being equal. If you didn't know what's going on in the world and just look at this chart on its own, certainly seems to be a fairly constructive pattern, right? You have this, higher highs. We've now stabilized. We have not made a higher high, and that's maybe a bit of a concern. We hit peak around 39, which is a similar high to what we saw in February. We've pulled back to an ascending 50-day moving average. And in general, in a healthy uptrend, you're going to find a stock like FCX pulls back to its ascending 50-day moving average a number of times. As long as that continues, the trend overall is pretty stable. When that stops happening, when we are not able to hold the 50-day, that's where we have to start to get concerned. And, when I think about the market right now, and I think about individual stocks that I'm reviewing and looking for potential weakness, those are the levels that I'd be paying attention to, keying in on some of those 50-day moving averages. So materials weaker today. FCX actually holding up, okay on the long-term basis, but certainly closing lower today and driving that as one of the weaker sectors. Energy was second from the bottom, then technology, and then financial. So it's certainly a mix of offense and defense, I would say, all around there. Very quickly looking at some other industry indications. So fixed line telecommunications, the number one group, that's the group with AT&T. So AT&T had earnings this morning as well. And, it's interesting. I was quoted in the media earlier today talking about Netflix versus AT&T. And it's interesting, Netflix is obviously built on streaming video, right? Streaming content. AT&T, you think of it traditionally as other things, but it really has come down to subscriber growth and HBO Max if you're looking at AT&T, or Netflix. And Netflix did not do well with subscriber numbers, underwhelmed the street, and as a result, the stock got hit pretty good yesterday. AT&T, on the other hand, nice positive news and breaking up. The reason why I'm bringing up this chart right now, by the way, is up about 4%. So it's potentially breaking up. But before you get too excited about the breakout, remember something like AT&T, which is a pretty high yielding stock, it often is better to unadjust the data. And what that means is, when you look at our regular charts, it's adjusting the data, which means it's adjusting for dividends. And something like AT&T, which pays a frequent dividend that's pretty high, it's going to change the data series dramatically. So if you unadjust it, put the little underscore ahead of it, you can see that we've not gotten above our December high just yet. It's around 31 on a closing basis. 31.50, which is that close there. We got almost up to 32. So we're sort of right in that same range right now. So my question for AT&T is, can it eclipse those December highs? It's not quite been able to do that. Although this seems like a really compelling base and a potential bottoming pattern, you really need to get above the interim high to signal all clear to the upside. So I would do underscore T and pay attention to those levels right now on AT&T. We need to take a quick break. We'll be back with my guest, Sam Stovall. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Really appreciate you joining us every weekday after the close as we look at the markets through technical analysis. The charts themselves can illuminate so much about investor behavior, fear, greed, euphoria, desperation, all of that. Let's go through them every day and try to make sense of these markets together. As a reminder, we'll do another mailbag segment on Friday's show. We would love to answer one of your questions on the air. Get your questions to us one of three ways. First, via email, thefinalbar@stockcharts.com. Second, on Twitter @finalbarsctv. Third, on our YouTube channel, just put a comment below the video that you're watching. We'd love to hear from you and hopefully answer one of your questions on Friday's show. Also, as a reminder, the new StockCharts TV on demand is available to you for free to access all of our great content, our fantastic hosts, and our incredible guests. Go to stockchartstv.com, use your email to set up a free account, start watching immediately. We're also on all the app stores, so just search for StockCharts TV on demand. I want to welcome on my guest, joining us again on the show, Sam Stovall. Sam's the chief strategist at CFRA Research in New York. Sam, I've always valued your opinion. You're a strategist, but always with a technically friendly bent. I would describe that. So I've always enjoyed hearing what you have to say versus what I'm seeing on the charts. And thanks for coming on the show today.
Oh, my pleasure, Dave. Thanks for inviting me.
So we are talking about seasonal rotation. As I mentioned earlier in the show, we're nearing sort of that seasonally weaker part of the year. And the question for a lot of people this time of year is sell in May, right? Is that something we should be thinking about or not? You've brought some data to support what you're saying. Talk us through your take on this sell in May phenomenon.
Sure. Well, as we approach the end of April, financial media frequently asks, should we sell in May? Should we go away this time? And the first question is, well, is it really just a quirk? Is it a large cap US phenomena? And what I have found is no, it very much affects large, small US as well as diverse international and emerging markets. As you can see in the chart, the left-hand grouping November through April, we see a pretty strong performance for each one of these benchmarks, not only in terms of the average price change since inception, but also the batting average. How frequently did the market go up at that time? And what we see then is May through October. However, there's a pronounced weakness. The S&P gained only 1.6% on average since World War II, but interestingly now was up about 2 out of every 3 years. Russell 2000 up only 1%, but sort of a coin toss as to whether it's going to be positive in that May through October period. MSCI EFA down about 1% and falling more frequently than it advances, and then ditto for the emerging markets. And the right-hand column basically says that the November through April period has beaten the subsequent May through October period a minimum of about 2 out of every 3 times. So yes, there is a pronounced seasonal softness, seasonal rotation that goes through large, small, and international markets.
It's interesting, and you're hitting, sort of the batting average, right? How often are these seasonal periods better than the other, but also just the returns? And it seems like a clear contrast. It seems like there's something there. It's not just a made up market maxim, I guess. Chart number 2 is looking at, the actual 6-month returns. Talk us through this one.
Well, people ask me, should I really sell in May? And I say, well, gee, if the market goes up about 2 out of every 3 times, and as you can see on the smaller blue bar on the left, May through October, the S&P gained 2.2% since 1990. Well, that's a lot better than you would get in cash. So the moral of the story then is you are better off rotating than you are retreating. And what I mean by rotating is gravitate toward those sectors that tend to outperform the market in the May through October period, which happen to be consumer staples and healthcare. Defensive areas, I guess the old saying is, when the going gets tough, the tough go eating, smoking, and drinking. And if they overdo it, they have to go to the doctor. Yet November through April, when the market does well, then it's the cyclical sectors, discretionary, industrials, materials, and tech that tend to outperform. So usually, like whitewater rafting, you let the market take you where it wants to go.
I love it. So there's clear. So and I love that idea of not just, a lot of us think all in or all out, right? Am I owning stocks or not? And what you're showing is it's actually more a question of rotating to sectors, to opportunities that are strong during different parts of the year. As we were getting started, Sam, we were talking about this ETF, which I actually was really excited to hear about. SZNE. Tell us about this.
Well, it is a seasonal rotation ETF put together by Pacer. And I'm fortunate enough to have my name as part of it. So it's the Pacer CFRA Stovall Equal Weight Seasonal Rotation ETF. It's a mouthful, so all you have to remember is SZNE, which is the ticker. And what it does is it gravitates toward the defensive sectors, 50% healthcare, 50% consumer staples, starting at the end of trading on April 30th, and stays in that position until the end of October, in which it sells the staples and healthcare positions, and 1/4 of the portfolio is assigned to consumer discretionary, industrials, materials, and tech. And the strategy, based on the custom index created by S&P Dow Jones Indices, has beaten the benchmark about 75% of all calendar years since 1990. This ETF has only been out for a couple of years, but it looks as if the November through April period of 2020 through 2021 will be an outperformer once again.
So congratulations on the ETF. I'm excited to know that there's an opportunity to get a direct sort of exposure to this sort of rotation. And it's worth reminding everyone. I think I've been doing this for just over 20 years, and the first thing I ever read about sector rotation was really a graphic that you had created that showed sector strength and weakness in different parts of the calendar year. So you certainly earned the right to have your name on an ETF, trying to signify that. Sam, thanks so much for joining us on the show. As always, stay safe, be well, and we'll talk to you again soon.
Thanks again, Dave.
That's Sam Stovall. Sam's the chief strategist at CFRA Research in New York. And it's funny, so often I'm asked this time of year about sell in May and go away. And that's the question, right? Should we sell in May this time? And, again, people like Sam that have done deep work on the topic, you realize what I've often found, we love to oversimplify and come up with a market maxim, right? Something like sell in May and go away, because it keeps it super simple, right? It's something easy to remember, to repeat. But what you have to remember is things like that don't just come out of nowhere, right? They're not just made up. They're based on a market realism, right? It's on a reality. This is how the markets have tended to perform. That's the reason why the phrase kind of works, and that's why often our real life experience going through the calendar year mimics some of those rotational signals that Sam was talking about. It's a great take. Our next segment is called Getting Sentimental. So, we looked at some of the charts that have been in pretty strong uptrends, a number of stocks pulling back to their 50-day moving averages, but others holding up just fine. And a lot of the sentiment data will come out every week on Wednesday through Thursday. So Thursday is a good time to sort of review where we're at with different sentiment readings and try to see what conclusions we can draw from it. We'll go through a series of charts, and this chart list called Sentiment Indicators is part of a set of chart lists. It's a chart pack that you can access as a StockCharts member. To access this chart list, go to your dashboard. You can go to your list of chart lists. At the very bottom, you'll see a little gray button that says Manage Chart Packs, and you will see a chart pack called David Keller's Morning Coffee Routine or something kind of like that. And it'll include the sentiment indicator list along with many others, which you're welcome to access, save in your login, tweak, do whatever you like with them. We'll start here with the VIX. And recently we did an Options 101 panel that was really a lot of fun to do. We had Price Headley from BigTrends.com, Lex Luthringhausen from Tradier, which is an options brokerage, and then Sean McLaughlin, who's the options strategist at All Star Charts. And we talked a lot about getting started in options trading and just how to get your, dip your feet in the water and how to get more comfortable with a new, a new asset class, essentially, right? Equity derivatives. But it was funny, we talked a lot about volatility. We talked about the VIX and the change in the volatility regime, sort of 2019 into the first quarter of 2020, where the VIX was, rotating sort of in the, 10 to 20 range pretty consistently. All of that changed, obviously, during the market sell-off February to March of 2020. From there, we sort of renormalized the range of the VIX, and it settled into sort of 20 to 40. And so for a while there, I had these lines on here and these shaded areas sort of indicating the obvious high of the VIX and the obvious low of the VIX. That's changed in the last month, where all of a sudden we've gotten below 20, and now we're in the the upper teens. So I always remind people something like the VIX, remember, it's not absolutely bound very much, right? You will have different phases where the VIX will be in a certain range, and then that will totally change. And when it breaks out of that range, I think that can tell you that we're sort of entering a different sort of scenario. So it's worth noting the VIX is coming off the lowest level since right before the sell-off in February 2020. I think that's an interesting data point to see that we've gone below 20 finally. A lot of these pushes higher saw volatility sort of in a similar range. Now we've actually gone below where we had been for quite a while, starting to hook higher in the last week or so. And I think that's an interesting thing to note, because as you could probably recognize from the chart, tops in prices usually are met or related to bottoms in volatility, what we call the fear gauge. Chart number 2 is looking at the AAII surveys, the American Association of Individual Investors. I think one of the great perks of this data series is that it's been going on for so long. Is it the most perfect measure of investor sentiment? Of course not. It has any survey data, by definition, has its own flaws and challenges, because you have a group of people. What's the sample size? Who actually is voting? How often are they voting? Those are all things that are kind of behind the scenes, and we just get a weekly number that we can play off of. But what I love is that you can look back in historical market periods and in historical bull and bear phases and see what the sentiment has been and look at where we're at now relative to some of those historical periods. What I'm noticing now is we have a level of bearishness around 20%. This is one of the lowest levels we've seen. If you look at the blue sort of purple horizontal line here, that's the current level. You can see that we very rarely have been this low. This is actually one of the lowest levels of bearishness that we would have. You think of the range from around 50% bears to 20% bears, we're at the lower end of that. That more often than not would be sort of a later stage sort of indication. It looks a lot like December of 2019, which is about a month or two before the peak, completely true. But you can also see some of those other patterns like April of 2019 before a pretty big sell-off. So it's one of those anecdotal things. When most people are not bearish, that tends to be when something negative is going to start to happen. On the other side, you have over 50% bulls. Talking with Mark Young from wallstreetsentiment.com, we talked a lot about what of these different data points to pay attention to. His favorite is just looking at the percent of bulls, and when it's above 50, that tells you we're sort of in that elevated euphoric bullish range. So that number above 50% tells you enough people are bullish that you could start to look for signs, or you should start to look for signs of market weakness, because all of those bulls theoretically have already bought in. Who's left to push the price higher? And the challenge with something like this, and the reason why it tends to work out as a contrarian signal, is when everyone's sort of all in, a little negativity gets very scary very quickly for everyone that's on betting on one side of the market. So from a sentiment perspective, looking at the AAII survey, certainly elevated relative to what we've been before. little bit different read looking at the name exposure index, the National Association of Active Investment Managers. So this is more money managers as opposed to individual investors. You can see it's basically, you say whether you're long, 100% equity, 200% equity, 0%, 100% short, 200% short are your choices. And so, euphoric readings on this indicator, I would say, is above 100%. Right now, we're just above 95%, which is similar to where we were last week. You can see that that's certainly in the upper end of the range. It's not the highest readings that we had. Here in January and February, we had some of the highest readings ever in the history of the indicator. And that, for me, was a bit of a cause for concern. We're not up to that point, but that's what I would be looking for to see if we get back above 100%. You can see looking back here in July of 2020, looking at November of 2020, it is not a topping signal on its own. For me, what it tells you is you are entering that environment, that sentiment environment where you want to start to look for signs of weakness. You have so much bullishness baked into the markets that you're then looking for contrarian sell signals, looking for breakdowns, looking for pullbacks, and you're on watch. Similar to when a market is overbought, it doesn't on its own tell you that the market's going to go lower. It tells you it's gone up a lot. So you have to start looking for signs of weakness. Finally, very quickly, the RIDEX flows at literally all-time lows. I have this inverted, so it's more in line where a high reading on the chart is a very low value, but it's sort of a contrarian bearish signal. Things are so bullishly positioned. And that's kind of what we have. And individual investors using the RIDEX funds are the most bullishly positioned that they have been in the history of the data series. That, to me, is when I put on my Humphrey O'Neill bearish cap, Humphrey O'Neill bearish or contrarian cap, and start to look for signals of negativity. We need to wrap this show. Go to the 3 and 3 charts in 3 minutes. Chart number 1 is looking at the NASDAQ 100. When I'm looking at the NASDAQ, it's not that the NASDAQ is going down, because it's not. The NASDAQ 100 has made a new high in April versus the high in February. That's actually fairly constructive. What's interesting to me is looking at the relative strength and how it's sloping downwards. We talked about with Sam thinking about the seasonal trends in technology, right? And in the May through October period, what tends to do better and what tends not to. Technology is not the type of sector that would most likely do better in the May through October period. And it's interesting to see that the relative strength is really coming off. So these new highs in the NASDAQ have not been confirmed by new highs in relative performance. That shows you how technology has not really been the juice here in terms of the NASDAQ 100 and the types of stocks you're getting exposure to. Something that is attractive to me, all else being equal, is a stock or a sector or a group, an index making new highs with the relative strength improving, which shows me not only is it working on a price basis, but it's outperforming other things. This shows you there have been better opportunities elsewhere. Chart number 2 is looking at small caps. And again, the concern I have looking at the small cap index is that it has not just stopped going higher, it's actually potentially making lower highs. This is starting to look like what I might call a complex head and shoulders pattern. If you think of a head and shoulders as a high surrounded by 2 lower highs, this is a high surrounded by a bunch of lower highs that are relatively stable on both sides of it. And a complex head and shoulders is very similar. You connect it to low points, which would be these lows. You continue that trend line, and if and when we break down through that trend line, you essentially take the height of that pattern and subtract it from the lows. If you look very quickly, that would put you down to around 183, 185 on the Russell 2000 ETF, which would be a measured move down to the 200-day moving average. So, again, it's at this point just stopped going higher after this bearish divergence. The question now is, does it break support? And that's what I'd be looking for on the chart of the Russell 2000 ETF, the IWM. Finally, we're looking at Intel. Intel's actually coming out with earnings after the close, right as we're recording this. It's been a heavy earnings week, and you've seen stocks fluctuate a great deal based on that. When you look at the unadjusted chart of Intel, you can see where you're right at the previous highs from before the sell-off in February, March 2020. We've regained those levels. We are at the 50-day. My question is, do earnings provide a catalyst to make a new swing high, or do we continue on down to 59, the next Fibonacci support level? Folks, that's our show for today. A special thank you to Sam Stovall from CFRA Research joining us from New York. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.